think it's changed over time. And this is what's so powerful about the private equity industry. Look, you have to think about what their incentive is because it kind of guides the outcome.
Yes.
Early on, they were very much like venture capitalists. They were out in the, edges of risk taking, doing all kinds of very difficult, gnarly deals. So if you look back in the history of private equity, these huge, crazy deals like RJR Nabisco or TWA Airlines were the first of the industry, and they reaped enormous returns. But there was a lot of risk, and it required very heavy-handed management. Oftentimes, what that meant was firing a lot of people. Over time, private equity has gotten institutionalized, and they don't generally feature themselves as a place to get the best necessarily returns, but they are places where you can put enormous amounts of money, where the likelihood of loss is extremely zero, and you generate very good rates of return. Now, again, this depends on whether you want to look at IRR or DPI, right? So a lot of people will market IRR, which, I think is kind of like a gameable metric. But, those IRRs can be 20, 25%. If you look at DPI, which is really how much cash you get back, private equity firms can generate 1.5 to 2x of the money you give them. But they do it consistently, and they very rarely lose money. So all of that is important into understanding what's going to happen in this cycle. These folks are going to buy a ton of these private software companies. I think that they are going to fire lots of people. I think they are going to make these companies run hyper efficiently, and they will make sure that they generate that 1.2 to 1.7x that has been historical. Very rarely will they lose money in these things. By the way, that's going to mean that a lot of these other companies will have to reset valuation. So you saw yesterday, Checkout.com went from a $40 billion valuation down to 11. You're seeing some companies only go down 10 or 15%. But it's
a process, isn't it, Chamath? Isn't this just like what happens in real estate?
It's the beginning of this process.
Yes, because in real estate, my understanding, having lived through these boom bust cycles, is the person living in the home still believes their home is worth, this incredible valuation. And then the people who want to buy it are like, that doesn't match reality. And then the real estate brokers go back and forth trying to get people to, go through this messy middle and come to true price discovery. A private company, it's hard to get true price discovery until they're on the brink of insolvency. They don't have the money.
Right. Well, we just got some data on that, actually. Can we bring this Cooley data in?
Let's do it. Yeah.
Yeah. So Cooley looked at
a law firm in Silicon Valley.
Yeah, they're a prominent Silicon Valley law firm. They looked at 1,000 deals over the last 3 quarters of this year. Mm-hmm. And what they saw is that the later the stage, the bigger the valuation correction. So Series D rounds went from $3.5 billion to $527 million. That's an 85%.
Oh,
yeah, that's an 85% drop. Series C went from $502 million to $130 million. That's a 74% drop. Series B went from 164 to 90. That's a 45% drop. And then Series A went from 58 to 45. That's only a 22% drop. There's just less room to compress there. But the point is that Series B, roughly a 50% drop, Series C, roughly a 3/4 drop, and Series D, roughly a, like I said, 85%, 1/7 drop. So I think founders right now they're just like a little bit delusional about this money they raised last year. They're still way too anchored on last year's valuation. And if only they would think in terms of this capital they raised last year, in terms of its real dilution in terms of what the company is worth now, I think they'd be treating it more precious. So for example, example, hold on. If you
it's like they won the lottery and they don't realize they won the lottery. I had this conversation with the founder.
This is the only money they're ever going to see is the bottom line. And they're spending it like they're going to win the lottery every year. So for example, let's say you take a company. Yeah. Let's say you take a company that raised $200 million last year at $2 billion. So it was 10% dilution. So in their heads, they're thinking, oh, well, this isn't that expensive. Like 10% dilution's a rounding error. But really, probably the company is worth maybe $400 million now, right? Because it's gone down 80%. Yes. This $200 million of your $400 million is half the value of the company.
Yes.
And you're squandering it. You're squandering it at a rate of $100 million a year. So you're basically burning up 25% of the value of your company this year and then next year. And then, by the way, you're going to be in crisis after that because you're probably
It's like a lottery winner buying like a giant super yacht.
I had an observation that a lot of the investors that sit on the boards of these companies, they have an incentive to not see those valuations come down too quickly, do they not? And so there is this sort of like interest in, hey, I don't want you to have to go reprice the company or do a down round because then my portfolio gets written down. And then I'm in the middle, everyone's always in the middle of a fundraising cycle with LPs. And then I'm going to have a tough conversation with my LPs about my value. So do you not see VCs and investors playing an active role in trying to keep the valuations propped up to some extent, particularly where they have big markups?
100%.
Either by extending bridge rounds or doing other sorts of,
Look, nobody likes to go through a down round, and that includes founders and existing investors in the company. That being said, we're not talking here about new financing conversations. What we're talking about is advice that is happening in board meetings. And, maybe other VCs aren't pushing as hard as we are, but the advice I'm giving in board meetings is what I'm telling you publicly today, which is this is the last money you may be able to raise on attractive terms, if at all. You need to treat it much more preciously. The world has fundamentally changed. And by the way, we haven't even gotten into what's coming, the demand contraction that's coming next year.
Explain what demand contraction is for the audience, please. Thank you.
Okay, look, there's going to be three major sources of slowdown for software companies next year. Number one, new business is going to dry up. Companies are just going to be spending a lot less money next year because they're all cutting costs. So you should expect your new business to be roughly 50% of what it was. Next year, it'll be 50% of what it was last year. That's my rule of thumb for most companies. New business down 50%. Number two, churn is going to be higher. We haven't seen that much logo churn yet, but next year, a lot of companies are going to start going out of business, and it's going to happen over the next 2 years. So you're simply going to see logo churn rates, say among small businesses, go from like a historical norm of 15% to maybe 25 or 30.
In other words, your customer, the logo
is simply
goes
not going to exist.
Poof.
Yes.
That's what a logo means. Yes.
Yes. And
the actual entity.
Yes. Logo churn means the entity doesn't exist. Then you've got seat contraction, which is these companies are not hiring as fast. In fact, they're doing layoffs. So they're simply not going to buy as many seats of your software as you need to in the past. For the last decade, we've had a tailwind, an enormous tailwind for software companies of seat expansion, which is every year your existing customers would buy more seats of your product for their new employees. Now they're actually going to have fewer employees or maybe headcount freezes. So they're actually buying fewer seats.
By the way, if you take all those three things, the deal of the century was Figma selling to Adobe for $20 billion.
Sir. Yes,
because if you take those three things, I mean, oh my God, they just absolutely top ticked before any of this stuff was known.
Totally.
So today Adobe could probably buy this thing for like $7 billion instead of $20 billion.
So does that mean they tried to do a breakup fee and get out of the deal?
I don't know, but if I was Figma, I'd try to close this thing ASAP and get that money.
Yeah,
Yeah, you're right about that. And by the way, what I'm seeing from founders is that they still want to grow 100% plus over the next year. The problem is that the headwinds are going to be intense. So if you're flying a plane and the headwinds are extremely intense and you try to maintain your speed, you're going to burn an enormous amount of fuel. You're going to be incredibly inefficient.
Yeah.
It's better to basically just moderate your speed, let the headwinds basically pass. We're going to have major economic headwinds for the next 4 to 6 quarters, call it a year and a half. It's okay to have a slower growth rate. Preserve your cash. Don't burn up your fuel.
Yeah, bunker down.
So what we're trying to do is we're trying to give permission to our founders to grow at a slower rate because they feel this enormous pressure from their VCs to grow at insane rates.
Can I build on this? I think Freeberg said it very well. The scam in venture capital is demonstrated in the following chart. This is using Cambridge, and our friend Brad Gerstner helped put this together. So what is this? This goes back all the way to 1997, and the gray bar is what venture capitalists share with their limited partners as to how well they are doing. What is
top quartile of venture capitalists.
And this is the top 25%. Okay. Yes. So this is a venture capitalist, and our returns have been consistently top quartile. So instead of cherry picking anybody else, I'll just use us, but it could be Sequoia, Benchmark, you name it. We would go back.
We're in there.
Launch. You would go back to folks, Craft. We would go back to folks and say, hey guys, the total value of our portfolio is 3 times your money in 1997's vintage. Okay. It was 4 times your money in the 2010 vintage. Feels really good. But again, the job of the venture capitalist is to convert the gray bar into the purple bar. And historically, there's been a decay. So for every dollar of gray bar that you show, you typically only get 73 cents actually returned to people. Okay.
Mm-hmm. The paper value, the book value.
Just to be clear,
versus,
the valuations that you get when you sell your company or goes public end up being 73% of what you marked at the peak, what you said they were worth.
Exactly right. And the actual value of this purple bar, going back, 30 years, is 1.7x. So just to put numerical numbers on this, if you were a venture capitalist, you would raise a $100 fund. At the peak, you would actually show that $100 became $200 and about $28. But when push came to shove and when it was all said and done, you would return $170 back to your investors. That's the rough equation. So what's the problem? Well, the problem, as you can see in this chart, is right around 2015, which is all of a sudden, what we've started to see are these continually elevated gray bars. Yes, this stuff is worth 7 times, 6 times, 5 times. But we have not seen the purple bars catch up. Now, some people will say, well, yeah, but you have to give it time. And, this is probably what other vintage look times. And all you need to do is do what's called a regression. And you need to regress these things to the mean and make the following assumption. Assume for a second that this time is not different. Assume that these historical averages, 2.2x, 1.7x holds. Well, that's what the black line here shows. You can calculate the area above the curve as the value at risk, right? The amount of money we will destroy because of all these shenanigans that Friedberg just talked about. Propping up marks, not willing to look at actual market clearing prices. Well, if you do the math, the sum of the area above this black line is almost $1 trillion around the world. And it is about $600 billion for US venture capitalists. This is the dynamic that the private equity industry is going to prey on. So if you saw Thoma Bravo just closed a $32 billion round, Vista's raising a $20 billion round, everybody's stepping into tech. They are going to destroy those gray bars.
Would you describe that as bottom feeding?
No.
They are
the rational actor who is finding the true market clearing price. Again, I will say this. I think the private equity industry is unbelievably precise and talented in being dispassionate and telling us what these things are worth.
They're cutthroat. They're logical.
No, it's not cutthroat.
Hold on a second. That opportunity for the private equity industry is going to be created by profligate founders. And look, you could blame VCs for the high marks last year as well. They were profligate too. But look, if you're a founder, if you don't start acting in a more capital efficient way and preserve your cash, your company is ultimately going to be owned by a private equity firm and they're going to make all the money.
Well,
because when you sell to them at a low price, all you're going to end up doing is paying back the liquidation preference. And then that private equity firm that was willing to do, or less, but that private equity firm will be willing to do what you were not willing to do, which was simply cut your burn, cut your costs, and act in a more capital efficient way. And they will end up making all the upside for your decade of hard work because you got basically addicted to venture capital and the high valuations and refused to, again, adjust to the regime change that we're describing.
I'll give you an alternative. The alternative is that the majority of acquisitions made by private equity firms are not actually pure acquisitions. They're bolt-on acquisitions, meaning that these are companies that are added to existing platforms that they own. So this acquisition they're doing of Coupa, I think it's very likely over the next couple of years, you will see like the playbook in private equity includes not just cost cutting, but also synergy building. And they typically do bolt-ons and add-ons, and this happens across all private equity platform deals, of new products and services that can be sold through the existing sales channel, the existing customer base, and as an add-on to the existing service or product that's already offered. So one of the things that I think you may see in Silicon Valley over the next couple of years is a rationalization away from funding feature companies and thinking much more carefully about what can be true standalone product companies.
Sure.
And many of these companies that have raised a ton of capital, and have gotten crazy valuations, at the end of the day, they're more likely better equipped to be a feature of another platform than they are to be a standalone platform company of their own. And that's where the majority of these acquisitions will likely end up going in the private equity landscape. And they will be vacuumed up and attached to existing platforms that these private equity guys are building out. And by the way, just look as an example at what Oracle did over the years, what Salesforce did over the years, what Google did. So many of these companies
bolt-on acquisitions,
by building a sales channel, building a platform, and then adding on top of that. And I think that's what a lot of these guys are going to try and mimic.
Two critical points. Number one, what about the bottom 75% of VCs? Oy.
If you show that chart just for one more second, I just want to remind everybody, that is the absolute cream of the crop VCs.
Top 25%.
This is the best of the best. These are folks, I mean, again, I'll just say, us, Sequoia, Benchmark, we've consistently been top quartile.
Thank you.
Launchcraft. These are top
Chef's
quartile
kiss.
Return streams.
Thank the Lord.
What about the bottom 75%?
They're not going to be able to raise funds, man. It's over. A lot of these people who raise first-time funds in the last 3 or 4 years.
It's also the companies, as Zach said, because it's like today is now is the moment for the sober founder and the sober venture capitalist to sit and say, what is the real valuation? What do we need to do to make sure that this company has a chance? Because what Zach said is so true. Otherwise, all these profit dollars will be made by the private equity firms.
In order to win today, you're going to have to grind. You're going to have to work 50, 60 hours a week. You're going to have to absolutely embrace the age of austerity, and you're going to have to focus on your customer, your product, and your bottom line. The age of excess is over. If you're not working 50, 60, 70 hours a week, you're not going to cut it in Silicon Valley. Also, key second point, profligate. Extravagant or wasteful in the use of resources, just so we get the word of the day from David Sachs. That's David Sachs's word of the day. After a very powerful bull weevil.
This is
weevil? That went crazy. Did you see the Tremont? Bull weevil went...
bull weevil.
Went viral.
This is, I think, Elon's biggest non-obvious impact in this moment.
JCal, here's your one answer to your question about what happens to the bottom 75% of venture firms. It's equivalent to what happens with the, this is the bottom of the top, the slide that I just shared. It's the one we looked at a few weeks ago. And I keep referring to it because it's just such a staggering demonstration of what people call the power law, which is how, kind of excess returns accumulate to minority of investments. So just a few investments make up the bulk of value. That the, market cap of 43% of companies that have gone public since 2020 is $750 billion. The market cap of the other 300 is only $26 billion. And the cash that went in to the $750 billion is 136. And the cash that went into the 26 is 107. And so the cash that went in to generate that 26 billion, that 107, that's your bottom 50%. And the top 50% put in 136 to make 750. And I think it gets even narrower as you move further up to that top quartile. So, it's just
I can tell you what LPs are saying because it's
a hard business to try.
And by the way, this is the companies that went public. So this is also of the top company of the top funds and the top companies that were actually able to IPO. And so it highlights how much of a power law actually plays through. And so the majority of these companies, Chamath, even in your chart, you show the top quartile. The bottom 75% or the bottom 50%, I've looked at this data as well, of those various vintages are below 1.0. They lose money for their LPs.
Oh, consistently.
And it's a cycle. And so what ends up happening is the next generation comes through and LPs, they make a portfolio of bets and they hope that they make enough bets in the right VCs that their portfolio generates greater than, market returns, greater than, call it 15, 20% target, 15% target. But they're going to expect that the majority are not.
I have an LP report. I'm out there raising Launch Fund 4 right now, and I moved from the accrediteds, the individual investors.
Are you allowed to say that? Oh yeah, because you're
I'm on 506C. Yeah. So I'm publicly raising it, and I've moved on from individual investors, $45 million in commits after 5 webinars. Amazing. Now I'm talking to. No, it was amazing. It's just 506C is going to change the entire industry, letting the masses have some access to this capital and this opportunity. Accrediteds and QBs is going to change the world, I believe.
Do you have to deal with every one of them, or is it easy to administer?
It's incredibly complex because you have a large number of people and they all want to talk to me. So I did webinars, 5 webinars, and it resulted in hundreds of commits for $45 million.
But you'll be able to get all those capital commitments drawn down when you need to. Like you have to go ping a couple hundred people and get them all to wire money to you.
You need to have more operations people, and we only do four. We let
Jason,
them.
One thing you may want to do is like for these smaller slugs, is you can pre-wire, you can set up an escrow account where you pre-wire 100% of the capital.
Yes. And then you also don't have to, you take it down when you're going to deploy it so you keep your IRR correct. So we're actually looking into those solutions. I'll talk to you offline. But I just did my first 2 meetings with endowments, et cetera, fund of funds. The entire discussions right now are around what is your secondary strategy? How are you getting in earlier, not later? And how are you building a larger position? It is, and even like some of the QPs who are sophisticated and are in over 10 venture funds. The entire discussion, governance of these companies, are you taking board seats or not? How early are you getting in and building a larger position over 10%? And what is your secondary strategy? When are you going to start taking some chips off the table? So and I got to say, if you're an LP who didn't sell into the up market at all, and you're on your first fund, and you had all these great marks and they're coming crashing down, they're not going to deal with you. They just have too many options of top funds in the quartile.
I don't think they've started to come down yet. I don't think we know what the top quartile is really going to look like over these last few years. I think that's going to take 4 or 5 years to really sort out.
Yeah, of course. Yeah.
So I think
explain why, Chamath, just so people understand. Yeah, I understand.
Well, I think that there are lots of valuations that have supported huge TVPIs, these paper gains that have allowed venture funds to raise enormous amounts of incremental capital in new funds. And so they are going to try to wait as long as possible before they're held accountable for that. And the best way to do that is to not change the valuation. And so it will happen slowly. It'll be a trickle of these things. And I think that takes probably 4 or 5 years for it to really sort itself out. But in the meantime, companies will still need to get financed. Companies will still need to get built. That's why I think like the public markets, I think what SAAS says is true, giving us a signal of what these true market clearing prices are will eventually slip into these, Series D or E companies, because the venture capitalist who has now taken some big write-downs in one part of their portfolio, I suspect will now be very open to selling to private equity for another part of their portfolio so that they can return capital.
Totally agree.
Yeah, it's going to be rough out there.